Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
I think what we're starting to get into at the moment, and I'm probably preempting a conversation about AI later, is whether or not you start to see broader weakness. Because when you cite some of those job cuts, places like Morgan Stanley, for example, that's a slightly different composition of softness, and that those types of consumers have a much higher propensity to spend. When you're thinking about consumer spending going forwards, that is the area where you get relatively small numbers of job cuts can have a kind of magnified impact on the potential economy going forwards. But just to zoom out a little bit, generally this time around, the consumer is in pretty good health. Consumer balance sheets are pretty good. We're not in a situation like we've been in historic slowdowns, if you like, where you've seen real kind of consumer fragility. And so I think that's a real positive. I think what we're probably have been dependent on from an economic perspective over the past 4 or 5 years, particularly in the US, has been continued fiscal expansion. And I think what we're seeing there is a kind of that it's difficult to paint a path for significant fiscal expansion in most developed countries now, given constraints around debt levels and such. And so if that lever goes, if the consumer starts to soften a little bit, then we're left kind of with the investment side. And again, we've had a huge positive tailwind there from AI capex spending. That's really kind of keeping things motoring along at the aggregate level at the moment. So if that starts to weaken, then there's a little bit there's less, we've got fewer kind of big tailwinds, if you like. So I think generally, given how long this kind of economic expansion has been going on for, even absent COVID, we're in a reasonable place. But yeah, I think you're right. I think there's a little bit more fragility in some of those kind of core legs, if you like, that have been holding up the kind of global economy for the last 3 or 4 years. Are starting to see a little bit more fragility.
Yeah, that's a great point. And just to look at this chart, we have had caution building in the background for some time now. Actually, the last 6 months, underperformance of the S&P, S&P relative to gold, performing quite poorly. Gold clearly remaining at the 4, despite some volatility at the beginning of the year. And we've definitely shown charts in the past showing how that because of that K-shaped economy, that lower end consumer really is not moving the needle when it comes to expenditure. But it seems that this kind of caution has been creeping in, certainly across the board. I did Bloomberg yesterday, and I spoke about the concept of shock absorbers because they spoke about the geopolitical shock. And I think it's safe to say that up to recently, geopolitics did not really create that many shockwaves throughout markets. They seemed somewhat resilient. But because there was the shock absorber seemed to be that strength of AI, the strength of the tech story, which really did shore up the US economy. So if the edifice are starting to show, the cracks in that edifice are starting to show, I think that's where, if we don't have that as a shock absorber, perhaps that's what was in mind of investors as things did start to sell off over the course of this week. So obviously we don't need to restate what the geopolitical news has been. And we're still very much in the throes of early days of the kinetic action in Iran. This is the sell-off that has been taking shape so far. This was only 2 days into the trading week. We saw selling intensifying by the stock markets, particularly in emerging markets. We saw gold sell off, interestingly, as maybe think about as a safety trade. We saw oil rise dramatically, and we had seen oil definitely very sensitive to rumors coming out of that region, and the dollar strengthen. So I suppose you and thinking of your asset allocation approach, when you see, is this sort of in the scheme of what you would be expecting as a scenario analysis as you think about the geopolitical news? Is this how you would have expected some of these asset classes to react?